welcome. You're watching The Big Question with me, Tamanna Inamdar. Today we're asking a question that we here at NDTV Profit talk about pretty much every day, all the time. We're constantly tracking stock markets, we're speaking with equity investors, we're speaking with people who are part of that entire ecosystem. But the fact is that the number of people who get impacted when markets are as turbulent as they are right now has grown exponentially. We've had a record increase in demat accounts. The proliferation of online broking apps means there is literally trading on the go. The amount of trading volumes and the quantum of each trade has increased massively, which is why when you see markets tanking the way they have this week, you wonder what is happening to your investments. Is the party over? Remember, we've seen pretty much a one-way move in Indian equity markets the last few years, especially after COVID-19. Is that now changing? Have we hit the pause button on the bull run, and are we heading towards a bear rally? I think the biggest question is, how should we navigate this market turbulence while making sure you don't lose out on long-term investments? Is this a time to change your strategy? Perhaps every stock tip you get is not going to get you the returns that you've seen in the last couple of years. Maybe those high double-digit 20-30% returns will be the thing of the past for some time. So then what do you do? Before we start on that conversation, let's tell you specifically what a bear market is and are we there yet? Now, a bear market is defined when there is over a 20% drop from the highest level of an index or that market. If it's about 10%, we are seeing a correction. Nifty's current decline from its highs is at 12.3%, which means we're about 8.6% away from a technical bear market. Now, when would you say that we are in a bear market? That is when Nifty falls below the 21,021 mark, lagbhag, thereabouts, we would be entering a bearish zone. Now, in this case, what should you do? Now, remember, we don't know. We can't really predict markets. The winds could go anywhere. There is so much uncertainty right now, so much which is out of your control as an investor. And even the biggest market veterans will not stick their neck out and really guess what's happening next. But let's get their view in any case to guide you on this question. What should you do in turbulent times? Manish Dangi is joining us today. He's founder of Macro Mosaic Investing and Research. I'm speaking with Parag Thakkar, Head Fund Manager at Fort Capital, and Harsha Upadhyay, CIO of Equity President, Kotak Mahindra AMC. Welcome to all of you, and thank you so much for joining us today on The Big Question. I hope my setup comments have sort of laid the context of what we're talking about today. So Harsha, I'll start with you. I think people want to first understand where we are. This kind of consistent fall that we've been seeing, are we heading towards a bear market?
Tamanna, to use your own words, I think this is clearly a pause in a long bull run. India is continuing to be a great growth story. I don't think there is any doubt about that. So if you are a long-term investor, if you are okay with volatility in the interim, I think this is still a very good market. However, we should also realize that market internals have clearly changed. Most of the indices are now trading below 200-day moving average, which means that they are trading below the long-term trend lines, which shows that there is a downtrend in the market. But that doesn't mean that we are unlikely to recover. As we see a recovery in economic growth numbers, as we see slightly better earnings numbers, we should be, and with correction of valuations, we should be able to see better days for equities. However, I should also caution the investors that what we saw over the last 4.5 years, post-COVID pandemic, was clearly an unusual market. One, the entry valuations just after the COVID pandemic was very, very attractive. And also the earnings growth was really, really surprising positively all through. And the breadth of the market was also very, very strong, given that most of the businesses really did well in terms of the earnings growth. Now that seems to be changing with economic growth slowing down a bit, corporate earnings growth clearly on the back foot, and valuations having reached higher levels. So to that extent, we should not expect the same kind of one-way market, what we have seen over the last 4 or 4.5 years going forward. We should expect some amount of volatility. And also, we should moderate our expectations going forward. Most investors have seen very, very strong returns over the last 4 years on a CAGR basis. I think now we are headed for a period where you will see moderate returns with probably higher volatility.
So let me break that down. A couple of things that you said there, Harsha. First of all, you talked about valuations. What do you mean by valuations? What do we exactly mean by valuations? Let's start there.
Valuations are different from the prices. Most investors recognize where the prices are headed. However, they don't realize what valuations they are paying for that particular price. So, for example, if earnings growth is not moving in line with the valuation in the market, then obviously the risk is increasing. What we have seen over the last 4.5 years, the average price to earnings multiple of the market has moved beyond the 10-year averages, even for the large cap basket. When you look at mid and small cap basket, it's at a premium of almost like 40-50% now, even after the correction, which is a serious excess valuation, one can say. So for that to continue sustaining, you need similar kind of expectations to continue in the market, and those expectations need to get beaten almost on a successive quarter, which has not happened for the last 2 quarters. If you look at last 2 quarters, for example, Nifty earnings growth has been a very anemic 3.5-4% year-on-year growth. Whereas if you look at mid and small cap basket, by and large, most companies have delivered a negative 15 to 20% earnings growth in the previous quarter. That's where the valuations become important, which means that you have already expected a lot of improvement in the earnings as of now. However, that situation seems to be changing. And if that is changing, should you still pay the same kind of valuation, or should you be paying lower valuation? When you talk about lower valuation, that also means lower prices for the same set of stocks.
Okay, so you're paying too much. You are discounting future earnings. Your stock price is going up, assuming that the company is going to start or going to keep earning at a better and better pace, but that's not what the actual earnings look like. This is why we cover quarterly results. Manish, let me come to you on that point. A lot of people watching this are wondering now, how far does this go? Are we entering a break period for the bull run? For how long? Are we going to continue to make the kind of money that we've seen in equity?
So on the kind of returns that you'll make, I concur with Harsha, of course, and I think all reasonable analysts concur that last 4 or 5 years returns have been exceptionally high, and there's going to be reversion to mean. You should expect in equities 4%, 4.5% over bonds. If you actually enter in markets at moderate valuations, and Harsha and you both explained what valuations are. Valuations are still expensive, not terribly so relative to what they were 4 or 5 months ago. And so therefore, you should expect less than average returns over the next 3-4 years if you enter all in here. Also, investors must recognize that the narrative that got built up over the last 3-4 years of Indian exceptionalism is clearly wrong. I've made this argument many times on your show. Our growth trajectory, our economic strength is decent. It was as it was before COVID. Nothing significantly has changed there. And so to that extent, for markets, it's business as usual. Final point is that in India, in last 30 years, every 3 or 4 years, you have a 20% cut in markets, which is what you call bear markets. It's been really long that has happened. So if it happens, markets are sort of kissing the usual, and there is nothing unusual happening. So I would be surprised if, markets don't...
Do you think, then let me come back to my first question. Do you think that we might be looking at a bear market, that this has just started?
Some parts of the markets, Tamanna, have already entered in bear market. Of course, larger... see, there are many ways, and, because we are talking to retail investors, perhaps, not sure we can communicate this well, but there are a lot of walls. Let's say if the currency gives up a lot of strength, what has happened in currency, let's say, in last 1 year, or especially in last 1 or 2 months, that itself actually neutralizes the high valuations. So in last 3 years, let's say in dollar terms, you made only 12-13%. So in some sense, the froth is more in INR terms, not in dollar terms, because dollar did not deliver as much. Dollar terms in Indian equity did not deliver as much. So are we entering in a bear market? Sort of no one has the crystal ball. I would be surprised if markets do not disappoint even at these valuations over the next 1.5 year. But for an investor that we are talking to, if you're doing an SIP, I'm little cagey in telling that you take the chips off. Most likely you are accessing market through SIP, and that is what you must continue over next 2-3 years. And perhaps that would sort of get you still that 4.5% excess risk premium on average for the capital that you invest over next 3-4 years.
So just on SIPs, gross SIP numbers at a record high. And this is, of course, the monthly investment you put in mutual funds. So that's what I mean by SIPs. But actual flows are much lower. In fact, in recent months, net flows have fallen about 35%. What is being seen is that people are preferring to invest lump sum, because I suppose people have also realized, Parag, just come in on this. People have also realized that these are the opportunities to come in. Do you think that the Indian investor is now mature enough to say that we saw what happened in COVID, and those who were brave enough are still sitting comfortably, that when at lows you come in? Do you think that that is the attitude that is there, or there is a bit of nervousness right now? Because regulation has also come in, right? There has been a squeeze on F&O trading, etc., futures and options. That speculative kind of trading is being curbed. What is the mood out there?
So first of all, I would like to say that after a 10% correction in the market and what we are seeing in rupee, what we are seeing in dollar index and US 10-year bond yield, after the Trump trade has begun, has, I would say, reduced the enthusiasm of retail and HNI towards the market. And so just for your viewers, I would like to share some positive thoughts and why they should continue SIP. The most important thing is that India's macros are very resilient today. Fiscal deficit, current account deficit, and most importantly, which I would like to address, is corporate balance sheets are very strong. Banking balance sheet, at least the large cap banks who have not lended to unsecured loans like MFIs, the balance sheets are extremely strong. So I would say there is a political stability. So I am not in the camp of a bear market for sure. I am in a camp where it is a time-bound correction, and as Harsha and Manish explained, that we ran out of, ahead of time in terms of, because earnings for Q2 were muted, GDP growth was 5.4%. But I think everything is going to change over next, and as we say in life and in stock market, everything negative has happened together. And that has reduced the enthusiasm of the investors. And still, I am saying that don't put your entire money at all in at this prices also. But one should continue with SIP because
I agree with you, Parag. But SIP, the fact is, last few years, SIP funds have grown massively. And I'll take Harsha's view on the data that I just cited. But more and more people have found it easier, have now learned, and are interested in direct trading as well. That's a fact. We have a whole generation of Gen Z who are just, trading at every opportune time that they get.
Yeah, so
they don't have the patience that you're talking about, Parag.
No, but the point is that I would say that you can ask any high-risk traders and high-risk speculators in the market that last correction, and as you rightly said, 12% correction from highs, and the way mid-caps and small caps have been, I would say, rogered, most of that enthusiasm is right now taking a backseat. I think it is back to basics because India is a country with macro resilience and political stability, and corporate balance sheets are not leveraged. And just to go on one point, valuations. Valuations, I would say that wherever there is demand supply kind of thing in mid caps and small caps, there the valuations went up through the roof, or where there was a very high confidence in earnings that this company is going to grow at 30, 35, 40%, and some narratives built around so many other things. I would not like to specify those things, but there the valuations are stressed. If you see the large caps, for example, and here again I'm putting a disclaimer of stocks, some of the stocks which we have in our portfolio. Some of the stocks are trading at, especially in financial space, are trading at 10p, 7p, 12p, 13p. I will not call it a irrational thing to happen, but there the growth is also expected to be lower. So where markets
okay, so then let's come to the point of what do we do? What do we do? Harsha, first, if you can address the point about SIP numbers, because this comes up every month. that the net SIP inflows, I mean, what have you been observing? Are there more lump sum payments? Are people rejigging their portfolios? Is there a response now to what we've been seeing around us from user behavior?
Tamanna, clearly we have not seen any significant change in terms of the investor behavior up until now. The monthly SIP numbers have been continuously growing by a few hundred crores every month, and new folios are getting added. You are right that the net number has always been lower than the gross number that we have seen on the SIPs, which used to be the case even in the past. Only in months where there were a lot of NFOs from the mutual fund stable, probably those are the months where the overall number used to be higher than SIP inflows. But otherwise, generally, the numbers have been slightly lower than SIP numbers for several months in the past as well. So I don't think there has been any different investor behavior that we are witnessing during the last couple of months that we have seen volatility in the market. I think there are two sets of investors or participants in the market, I would say. One, as you rightly said, there are so many people who are looking to make a quick buck in the market. Those traders and speculators need to be really cautious or alert in these conditions where there is so much volatility. But those who are long-term investors, obviously they have signed up for SIP, knowing that equities are not going to be one-way street, and the only way to beat volatility is to manage that volatility through putting money at various valuation levels. And if they have made that choice, I think that's the right choice, and that will give them reasonably good returns over the long term, which has been the case even in the past. But as far as short-term trading is concerned, I think one has to look at external environment, what is happening to the valuations, what's happening to the sentiments, what's happening to the flows, all of that, which is a different cup of tea. But long-term investors, especially those who are into diversified mutual fund portfolios, need not worry a lot.
Okay, so need not worry a lot, but then that is a longer term view. Maybe this is the time when you remember the basics in markets like this. Manish, for anyone watching this who has made a decent amount of money in equities the last couple of years and is wondering whether it's still worth their time to look at this on a daily basis and what they should do, is there some relief around the corner according to you, or worse yet to come?
I think, markets have a couple of levers, of course, as guest alluded, that macro remains decent, internal macro, but the global macro, of course, is sort of very bad given the strength of dollar and high interest rates in US. And it will have a knock-on effect on what we are seeing in, of course, in our currency. But also, even though our economy is slowed, the interest rates in India are not coming off in hurry, essentially because US rates are very high. So that's incremental support that economy needs, of course, is not coming in. Second part, of course, is that earning has had a tremendous momentum for 4 years. That is, of course, rolling over now. Investors sort of must know this, that before COVID, for good 8-9 years, Indian earnings did struggle quite substantially. Our nominal GDP growth used to be only about 10%. And my suspicion is that we are reverting to that mean. And the exceptionalism that we saw in last 4 years, especially in earnings, of course, is dissipating. So to that extent, if you're sort of pressing for a good news, this March or in this budget, perhaps, that's not the way. Yeah. And so I want to go back to this very important point, market timing is such a, shall I say, rare craft, I mean, I don't know many.
It's a magic trick. It's a magic trick.
It's not magic, but it's a rare craft. Few of us have it. But you can, unless you know something very specific about an individual, you can assume that most people don't know it. And therefore, it is best to go to some craftsmen, some of them are sitting on your show here, who actually can do this. So, I mean, the only defense for most people, 99% people, is to be disciplined in investing, which is through some systematic manner. You can do at 10% of your saving 20, 30, 40 every month.
I want to pay the fee, Manish. I don't know if we have the time in this show, but we have to address that more and more people feel the agency and the ability to trade directly and make their own choices. I mean, no offense to the entire mutual fund industry, and of course, Harsha and others are doing a great job. But there are investors out there who don't want to pay those fees, who want to make their own decision, who feel they will make better returns.
Agency is not the precondition of carpentry or driving. The skill is the precondition. So, if you want to be a good carpenter, you must know how to do it. You want to do it is of course you could, but that is not good enough condition, I would say. And
Some
second
things
most
are not
important thing,
DIY.
Tamanna, that unfortunately portfolio management, a construction of a portfolio to ensure that the correlations across securities neutralize to the extent that you can actually extract some alpha. This is again a craft, and, these gentlemen sitting here perhaps learned over 10, 20, 30 years of their own experience. It is, unless you've got all the time under the sun to learn all of this, you really can't run a dukaan along with, managing money.
No, forget running dukaan. You can't be a student. You can't be doing 100 things. And I mean, the people who, we're talking about perhaps do not know what is alpha and how to extract alpha. They're just saying, ye acha tip hai, main le lunga.
Taman, I just want to make a point. I teach as a management institute, 2 of them, and you will be surprised that, and this is these are eminent institutes. 80% of the class of mine actually trade stocks actively.
I'm not surprised.
Which is shocking, for a 21-year-old kid, doing MBA.
Everyone, Manish, I am not surprised. This is who the show is for. I am not surprised. It is happening, and they don't know what they're doing. What we're trying to tell them is, now what should you do? And they don't know anything about extracting alpha. They just don't know. It's a DIY zamana. Okay, so they're not waiting for that 10-year carpentry course to take that analogy forward. But Parag, to round it off, brace for a bear market or cross your fingers and hope for better?
Hope for better, 100%. Because I would like to say that, I believe that worse things happen together and then positives also come together. Due to recency impact, everybody is cautious today. Everybody is cautious. And I'm again saying that one should stay away from froth in terms of paying high valuations, as Harsha very rightly pointed out. But there are pockets of value in the market for sure. I would like to name them. Banking, cement, followed by FMCG are my top bets, at least in the portfolio. And that is where the valuations plus whatever has happened in recent past is actually reflecting in the stock price. And so that is where one should start accumulating. So I am not pressing for a bear market simply because India's macros are very good. Global macros are very challenging, as Manish rightly pointed out, but they are also, I would say, they are near their turning points, I would say. Dollar index or the US 10-year bond yield both have risen too much ahead of Trump coming in, and they might also reverse. And once they start reversing, you will see a global macro also improving significantly. And so I'm not at all bracing for. There can be a correction 5% down from here on also. And that can be very, very painful for some, as you rightly said, the people who are leveraging and trading in the market. And so I would definitely advise not to leverage at all, and but just continue your SIPs or continue investing in the funds you trust in gradually in the market. No doubt, nobody can time the bottom. But I would clearly stand in that thumping the table view that in India, you cannot have a bear market where just because global macros have worsened so much. And there also I have a view that they might also turn positive.
So I love this. Parag is the eternal optimist. Manish, it gives you the other side of the story. And Harsha, are you playing it safe?
Tamanna, clearly one needs to reset expectations as compared to last 4 or 5 years.
I've been hearing this in the last couple of months, reset expectations. What do the reset expectations look like?
Clearly, it's not going to give you 30-35% CAGR kind of returns that the last 4 years have given. And that was an aberration. And if you go back and see 30-40 years of our markets, that's not the normal trend growth level for markets. So you need to reset your expectations. And also what we saw over the last 4 years, hardly any volatility which had more than 10% kind of a market decline. In reality, there are, certainly a lot of periods where you would see that kind of volatility, but it didn't happen. And just because it didn't happen in the last few years, it doesn't mean that it's not going to happen in the future. That's where you should reset your expectations and also expect more volatility. But I think 3 simple mantras for successful investing, easier said than practiced. One is prudent asset allocation. That means don't keep all your eggs in one basket. Second is regular and disciplined investing. And third, obviously, if you're investing in equities, you need to have a long-term focus.
Okay, so sensible, sane advice is what will carry you through at the end of the day. So to answer the question that we've posed today, brace for bear market. I mean, you should always be prepared for the worst, but not yet. You have technically not reached that phase. You're about at least 8% away from it on the Nifty. Yes, there are some parameters which would have already entered the bearish zone. If you're looking at your portfolio and you went a little risky with it, then maybe time to pull back. On the other hand, there's an interesting saying and made popular by a TV series, risk hai to ishq hai. I've never quite understood what it meant, but maybe it's time to figure out what it means to you in this market. Thank you so much to all of you for joining us today on The Big Question. And for our viewers who have tuned in, tell us what you think about the show. Tell us what you want to see us discuss. We're listening.